Now, let's talk about interest rates, right? I mean, yesterday, for example, the Indian government 10-year fell to around under 7 odd percent. In the US, many expect interest rates to be cut at some point later. Although the debate there is more widespread here, I feel there is a bit more consensus that the RBI perhaps is done for now. We are seeing peak rates from the Reserve Bank of India. What does all of this mean? Equity investors have been telling us all this year that you should increase your allocation to debt. Is this a good time to lock in these rates right to the highs if this were the high? Suyash Choudhary is head of fixed income at Bandhan Mutual Fund, and Lakshmi Iyer is chief executive officer investment advisory at Kotak Invst Advisors. Thanks very much, both of you, for joining us. Good to have you here. Suyash, so that simple question to you: am I correct in characterizing the consensus view here? If that were to be true about rates in India, what's the right way to approach this from an investment point of view in terms of debt investments? Go on.
Absolutely. The Western world is slowing. Rate hike expectations globally are now peaking and they have matured. So there is unlikely to be any volatility around that anymore. India has compressed its external account very remarkably. So external imbalances that faced us last year are out. Inflation is on a downhill trajectory. So we do think we are at the top of a rate hike cycle, and investors should be looking at quality fixed income, especially in the 3 to 6 area in our view. That would curb reinvestment risk as the cycle matures and some modest amount of rate cuts come through, even in India, probably over 2024.
Lakshmi Iyer is also with us. Lakshmi, hi. Always great speaking to you on the channel. We're in a situation where perhaps we have seen the last of the rate hikes from the US Fed, and now we could be maybe heading into a rate cutting cycle as well, although the Fed has not made that amply clear, but that is one narrative that's doing the rounds. In such a situation, what's your own view? What's the best way to approach the debt market?
Yeah, hi, morning, Sonia. Definitely the bond markets are in a situation where there is the cake and there is a cherry on the cake moment where the global headwinds are also kind of morphing itself into tailwinds, given what we just saw of the Fed outcome. And you're absolutely right, though there is no explicit comments of a pause. If you actually look at the Fed fund futures, they've already started indicating rate cuts. And that's reflective in the bond yields in the US, where the 10-year is trading at 3.34. So clearly, the momentum seems to be sustaining in the Indian bond markets also, where we have seen the yields come closer to the 7% mark. And more importantly, if you see, you look at the swap curve, the interest rate swap curve, the 5-year OIS is already trading sub 6%. So I think these are clearly telltale signs that puri kainat jud gayi hai to ensure that the bond market participants tend to gain.
That's an interesting phrase, Lakshmi. But is it too much of a consensus, or you think? I mean, the consensus does not have to be wrong. I mean, it can be right. Are we in one of those situations?
See, if you look at the macro data points also, if you look at the inflation numbers, which are likely to release, in the upcoming week, the trend line clearly seems to be headed on the lower side. That's number one. Number two is markets typically tend to discount events ahead of its happening. So while we are not rooting for a rate cut, clearly this is the phase where interest rates have plateaued out, and in a plateaued out scenario with expectations, maybe with a lag of maybe 3 or 4 quarters, depending on which region you are, whether it's the US or India, it looks like positioning yourself for that outcome is absolutely imperative. So it's not more about consensus. Also, investors need to keep in mind that it's not going to be slam dunk that, the moment you invest, yields only keep sliding on the lower side. It's going to be range bound because there is a week on week supply.
So Lakshmi, sorry, Suyash was saying that the correct bucket to look at is the 3 to 6 year, if I got that correct, to avoid reinvestment risk, etc. Would you agree?
3 to 6 year, the bucket, as we call the belly of the curve, looks pretty attractive given that the yield curve is inverted or flat as we call it. So yes, risk reward clearly warrants allocation in that bucket right now.
Okay. Suyash, how about you? What kind of returns on an average can investors expect now in the bond market, say over the next 12 to 18 months?
Sonia, I think the bigger question now, and obviously one cannot talk about returns because markets tend to be volatile, but the bigger question is over the last 1.5 years, bond markets have tended to be more volatile than other asset classes, which is why probably the relative risk premia has not been priced correctly. And, typically these are supposed to be safe haven asset classes. Our sense is, and basis the discussion we just had, bond market and quality bond market volatility is now going to start to subside. And, remember what we used to call the Fed put option, which means that the Fed rides to the rescue whenever something wrong happens, is considerably weakened now in context of the higher developed market inflation. So it's quite likely that other asset class volatility relative to bond market volatility starts to pick up. And that is also one very, very large reason to now be overweight quality fixed income in a multi-asset allocation framework as well.
No, absolutely. Got that. By the way, Suyash, what is the best instrument for viewers who are watching to get exposure?
Despite the recent adverse movement in mutual fund taxation, they are still at least at par with other savings instruments. So rather than direct bond route, we would think mutual funds, which give the benefit of diversification as well as quality control, would offer a good vehicle for investments. Like I said, intermediate bond maturities in the 3 to 6 year area would probably be quite appropriate in the current situation. Focus has to be on quality because credit spreads of all sorts have been considerably depressed over the cycle of very positive liquidity over the last 2 years, and they will likely move up somewhat over the course of the next year.
Lakshmi, you'd agree with that?
Well, just to add to what Suyash said, that remains to be a port of call. One can look at, high yield instruments. For example, given where we are in terms of the NPA cycle, there are certain mid-market entities which really don't have full-blown access to capital markets. So there is a space, for that as far as the fixed income is concerned. They may not be high on rating because they are not really well discovered, but clearly there is a case to look at select opportunities, in this space. They're largely offered, either on a direct bond route or through the AIF route, but it's a combination that is required to create a well-rounded fixed income portfolio.
Right. Got that. Thanks very much, Lakshmi and Suyash, for joining us. Appreciate both of you with that perspective. Thanks very much for being here on the program. Now, Indranil Sengupta is also joining us. Of course, looks at macros, economy strategy at CLSA India. Indranil, apologies, we're hitting you a little late. Thanks very much for joining us. You've been saying for some time, even before the Fed meeting, that there's a 100 basis point rate cut from the RBI coming in the second half of this year. After listening to what the Fed has said, does your view get solidified, or are you rethinking it? Your sense?
No, of course. This I think supports my view that the RBI will start cutting 100 basis points from October. I am very confident that the RBI will not want to sit at a 6.5% rate, where given where the global economy is, where we are in terms of growth, and inflation will also be coming down in the coming months. So we are looking at a 100 basis point rate cut now that the Fed has paused. Even if the Fed does not pause and hikes once or twice, then maybe the rate cut shifts from October to February, but there will be a significant amount of rate cuts either way.
Okay.
How will that happen, Indranil? Because the interest rate differential right now between, say, for example, where the US is, where we are, what is it, 1.5%
I think two-ish.
Two-ish.
So,
and you're saying that even if they were to remain there at about 5%, we will see a 100 basis point cut here. Has that happened in the past?
Yeah, because what will happen is that sooner or later the the FX markets will begin to price in Fed rate cuts next year. So we are looking at a 50 basis point rate cut next year. The Fed dot plot itself is looking at a 75 basis point rate cut next year. So from that perspective, the dollar itself should weaken to about 120 a euro come next March, and that will provide the RBI the headroom to cut rates in India.
Okay. So if there is a 50 basis points rate cut next year, and I mean in general, if we're looking at the US cutting rates next year and the RBI gets a certain amount of headroom to do that, what is the trajectory of the RBI? When do you think the rate cuts could start? And what is the quantum that you're looking at in 2024?
So we are looking at 100 basis points of rate cuts beginning October if the Fed pauses at 5/4. If the Fed were to, which is our base case, suppose the Fed goes to, 5.75, then maybe the RBI has to hike once. But then again from February, maybe it cuts another 125 basis points. Where I'm coming from is that we have a threshold inflation that's a growth maximizing inflation of around 5.5%. Given where the world is, I think if you are zero real policy rate, that's good enough. So once the Fed is done, I think the RBI can easily come down to around 5.5 to 5.75 on the repo rate.
Indranil, one of the things, and you have a view on the rupee as well, I'll ask you about that. What is the best analogy? I mean, if you've looked at history to compare in terms of how this will play out, is it 2008? Is it 2000? Do we have to go back all the way to, say, 79 to 81, the Volcker years? What is the best kind of time frame to compare what we are seeing?
So I think it's a mix of the Volcker years and 2006. So if you look at 2006, you had the Fed hiking till 5%, the RBI hiked alongside, the rupee depreciated, and once the Fed was done, gradually, the rupee appreciated back, interest rates fell and so on. So that is one part of the story. The other part of the story is that we are in a world of high inflation in the US almost after 40 years. So I think, right now there is a dialogue of the deaf that's going on between the Fed and the markets. The Fed says, I'm not cutting this year. The market says you're going to cut 100 basis points this year. I think the market is extrapolating the last few, recessions, which all happened with low inflation. The big difference this time is there is high inflation, which is why I'm saying it's a bit like, what happened in during the Volcker years. So that is why I think the interest rates have had to go up this much and may go up, further if the Fed were to, Fed were not to have confidence in its current forecast that inflation will go down to 3% in a year's time, and also have a longer pause than the markets are pricing in.
All right. A pleasure, Indranil. Great speaking with you. Appreciate you joining in with that perspective. Thanks very much for being here on CNBC TV 18.